What's up everyone, my name is Coleman, and today in this video I'm going to be talking about one of the weirdest, strangest, most interesting companies I've ever come across in the stock market, and that is Supermicro, ticker symbol SMCI. This is a company that projects to grow 20% a year, has good financials, but trades at a forward PE of less than 12. So in this video, I'll be breaking down the company and what makes it so interesting. First I'll go over the company. I'll go over the good, the bad, and the current state of their business right now. Next, I'll take a look at their financials and break those down. And finally, we'll take a look at the risks involved, my thoughts, and what I'm doing with this investment opportunity. If you like this video and find it helpful at any time, hit the like button since it really helps out the channel, and let's get right into it. So what is Supermicro, since it's a company that most people probably haven't heard of? Supermicro is a company that develops and manufactures high-performance server and storage solutions. If you didn't know, servers are used to process requests and deliver data to other computers, while storage solutions are required to store data electronically. They were founded all the way back in 1993 by Charles Liang, who's been their president, CEO, and chairman since then. Sarah Liu, one of their other co-founders, is still with the company too, and she's the senior vice president and sits on the board. So they're a founder-led company, which I like. Now I'm about to throw a bunch of data at you to help break this company down. Supermicro is a $1.7 billion company, and they have over 820 direct customers in over 100 countries. This has traditionally included large cloud providers and data center companies like Alibaba, Amazon, Baidu, and others. At the end of 2020, none of their customers represented over 10% of their sales. Additionally, sales to customers located outside of the United States represented 41.4% of sales. So the customer base is very diverse. They're also an engineering-focused organization, and last year 40% of their employees were in research and development, or R&D. This has allowed them to build a vast product portfolio, and in 2018, an IDC paper said they have over 5,000 product and component options. They work closely with AMD, NVIDIA, and Intel so they can deliver products to the market right away. Because of their close relationship with these three suppliers, Supermicro aims to be first to market with a lot of their products. This is a big deal because they have to compete with some of the largest companies in the world. It's an industry dominated by HP, IBM, Oracle, and Dell. Even with this competition, they were ranked the 18th fastest growing company on Fortune magazine's list of the world's largest US publicly traded companies in 2016, and they were also ranked the fastest growing IT and infrastructure company. Also, the IDC ranked them as the third largest supplier of servers in the world. In 2019, Supermicro announced the expansion of their Silicon Valley corporate headquarters, plus they announced a new 800,000 square foot building in Taiwan. They believe this Taiwan facility will help increase capacity for growth, and they'll also be able to run this facility at about half the cost compared to the US. So this is where the company starts to get more interesting. Supermicro sells its products to data center, cloud computing, artificial intelligence, 5G, and other high-growth markets. The IDC projects these markets to grow at least 2% annually over the next 5 years. But here's the thing, in Supermicro's latest investor update call this March, they were talking like they'll blow these projected market growth rates out of the water. Their CEO said he believes they'll grow 13% a year in the next 3 to 5 years in the organic enterprise market. That is a market that's anticipated to only grow by 2% a year. He also believes they'll grow their 5G, telco, and IoT segment 30 to 40% a year. That's in a market that's only projected to grow 8% a year. Also, in their Q1 conference call for their OEM and data center market, they said they just started to refocus on large data centers and OEMs. They plan to add 1 or 2 more large data center or OEM customers before the end of the year. When they add all of this together, they're targeting an annual revenue growth rate between 17 to 23% for the next 3 years. Now here's where things start to get crazy. If we look at the CEO's salary, you'll see he now only makes $1 a year with no bonus and no RSUs, which are like stock options. Instead, he gets paid if certain stock prices and revenue goals are met within the next 5 years. The first tranche is a $45 stock price and $4 billion in revenue. They're currently sitting at about $35 a share and had about $3.3 billion in revenue last year. So in order to hit this first mark, the stock price will need to go up about 25%, and revenue is going to need to increase about 20%. This compensation plan goes all the way up to a $120 stock price and $8 billion in revenue in the next 5 years. What's even more interesting is that the CEO hopes to do a second run if they surpass $120 a share in the next 3 years. Based on his compensation structure, his incentives are very aligned with shareholders, and he's extremely optimistic about the future. If these goals weren't large enough, they're actually looking to reach $10 billion in revenue within the next 3 to 6 years. And just a reminder, they're currently sitting at $3.3 billion a year in revenue. In their investor call in March, they were asked, do you view this $10 billion target in 3 to 6 years as ambitious or something you expect to be able to achieve? Their CFO responded by saying, I think that these targets are achievable. So they have some crazy projections, and all of this makes the company seem great, but that comes with some bad too. In 2016, Supermicro had some accounting issues that created a lot of problems for the company. According to the SEC, Supermicro improperly accelerated revenue recognition and reporting. For example, Supermicro shipped goods to a customer who didn't even want them delivered for another month. The customer wanted the shipment rejected, but the employee said, I was instructed by our management to push all orders out before our quarter end, which is also our year end. So they were basically trying to manipulate revenue to make their year end revenue look better. This resulted in certain financial statements between 2014 to 2017 containing misstated information. Ultimately, they were unable to file financial reports for nearly 2 years, which caused them to be delisted from the NASDAQ in 2018 and forced to trade on the OTC market. Additionally, during this time in 2018, Bloomberg released a story about a big hack and how China used a chip to infiltrate US companies. They claim Chinese spies managed to plant spy chips on Supermicro motherboards manufactured in China. Bloomberg claimed that almost 30 US customers, including Apple and Amazon, were reached by this. Between all of this uncertainty between delisting and the Bloomberg story, Supermicro's stock fell from its highs of $40 in 2015 to under $13 in 2018. Ultimately, the company was fined $17 million for their shady accounting practices. Their CEO was forced to reimburse stock profits, and their CFO, who is no longer with the company, was charged by the SEC for accounting violations. Once this cleared up, Supermicro ended up being put back on the NASDAQ in 2020. Also, more details emerged with the Bloomberg story, and it now seems somewhat unreliable. Both Amazon and Apple came out and said that the story was untrue. Additionally, Director of National Intelligence Dan Coates said that he's seen no evidence. And most newsworthy, Apple CEO Tim Cook said that they should retract their story, and there's no truth to it about Apple. We may never know the truth about the entire situation, but between the accounting scandal and Bloomberg story, this is a company that a lot of investors don't trust, and it's an interesting company to look at. So how have they historically performed, and how has all of this affected their financials? This is a company that's historically had excellent revenue growth. Since 2004, revenue has increased every single year except in 2009 and 2020, both of which were poor years in the economy. Also, from 2010 to 2018, Supermicro had a compounded annual growth rate of 21%. So until they had the accounting and other issues, this was a company that's grown revenues very consistently. In addition to that, Supermicro has been profitable in all 27 years since they were founded, which is very impressive. When you dig a little further, you'll see that they have about $107 million of total debt compared to $178 million in cash. Also, if we take their $1.6 billion in current assets and divide it by their $782 million in current liabilities, you'll get a current ratio of 2.1. So overall, they're in a pretty decent financial position. Another metric I like to look at for more established, profitable companies is ROIC, or Return on Invested Capital. This basically measures how well a company is able to use its capital to generate profits. Warren Buffett looks to this number because he likes to invest in companies that can use their capital to generate high rates of return. When looking at Supermicro's ROIC, you'll see that since 2009, it's been over 9% every year except 1 year. This means that when they allocate their capital, they're historically able to generate over 9% a year, which is pretty good. Even with their strong financial position, this is a company that trades at an 11.68 forward PE, which is unheard of in this market for a company that's projecting between 17 to 23% annual growth for at least the next 3 years. The S&P 600 small caps currently trade at a forward PE of 17.9, which is significantly higher than Supermicro's valuation. So the valuation of this company is pretty good, especially after looking at their financials and projected growth. So what are the risks with this company? What are my thoughts? And am I investing? In my opinion, the largest risk with Supermicro is their previous accounting issues. Although their CFO is now gone, their CEO and some of the other management are still with the company. The SEC said certain financial statements between 2014 and 2017 were misstated, so this wasn't a one-off event, and it happened for a few years. So there's a good chance that some of the current management knew about these problems while they were happening. This makes it really difficult to fully trust the management. There's also the risk about the Bloomberg story, and if that information were true. Although this incident has been denied by multiple companies and individuals, Bloomberg has continued investigating it, and in February, they released another report about the incident. So they're continuing to press forward, and they seem to believe that the story has merits, even though a lot of people have already denied the initial story. If this story ended up being true, it'd probably be really bad for Supermicro's business, since about 60% of their revenue comes from the USA. The final risk I see with this business is that their margins are very low. Although this is a company that generates a ton of revenue for a company their size, this doesn't translate to as much profit as you think it would. Supermicro has historically had only between 15 to 20% gross margins, and their 3-year goal is to have margins between 14 to 17%. These are just really tight margins, and when you have margins that low, there's less room for error. If any mistakes are made or unexpected events happen, it can turn your company unprofitable very quickly when you have margins that low. So what do I think about this company? Well, it's certainly an interesting and unique company, and in my opinion, it's one of the weirdest companies I've ever come across. As I've mentioned, they're projecting high growth, they have good financials, and they trade at a good valuation. On the other hand, there are some risks with management and the Bloomberg story. So after going over the situation, I started thinking, what are the odds the CEO and the management does anything shady again? The fact that the CEO only gets compensated if the stock price goes up gives me some confidence that another shady situation won't happen again. So I did open up a position in this company, and it now makes up about 1% of my portfolio. But I want to be clear that if it wasn't for the CEO's compensation structure, I probably wouldn't own this stock. It's a company that certainly comes with some uncertainty and distrust in the management, but I'm willing to give them a chance since their growth projections and valuation look good. Anyways, I'm curious to know your thoughts on the company. If you like this video, don't forget to hit the like button, and if you want to see more videos like this one, please subscribe and hit the notification bell. Thank you so much for watching, and I'll see you in the next one.